Good morning, Christian. How are you?
Very good. Thanks, Matthew. It's great to be here.
Fantastic. So where in the world are you today?
I'm in Vancouver today, but off to California and Brazil tomorrow morning.
Well, thanks for taking the time out to talk us through what's going on with the company. And I think you're going to take us through your most recent PowerPoint presentation.
Yeah, it's fresh off the presses, actually. So it's a perfect time. I mean, it's the beginning of the year. It's a new year. It's an exciting one for us. And I think as you see on the cover of that, it sort of says the 2018 report card. We had a big year in 2018, a lot of changes in our company, and 2019 is going to be just as exciting. So we'll give you a little recap of last year and then give you a picture of the company.
Wonderful. Okay, take it from the top.
So we got our usual cautionary statements on slide 2. I won't really pause there, but on 3, our report card for 2018. So at the beginning of 2018, we created Equinox Gold. It was the last week, basically, of 2017. And Ross Beaty brought in one of his companies, Anfield. We brought in Trek Mining, which had our Brazilian past-producing mine. And Richard Wark brought in Newcastle, which has the old past-producing mine in California. So in one go there, we did a 3-way merger. We put a similar philosophy and strategy together to create Equinox Gold. And we have a sort of pan-American profile at the moment. So we're in North America and South America. And our goal here over the next few years is to create sort of the next great gold mining company. Even this morning, if you saw Newmont and Goldcorp are getting together and doing another merger, you see another gold mining company being bought out. So there is a real void here to create these sort of mid-tier and larger gold mining companies. And Ross has done it over the years by creating Pan American Silver and silver. Now he wants to end his career with sort of his last go-round really on an active investment is Equinox Gold. And he started his gold career on Equinox Resources. And, you know, we're a reasonably young management team, myself and 4 of the other guys who came in here to create this company. And we had the same vision here. Over the next 3, 4, 5 years, we want to create sort of that multi-asset gold mining company that is a go-to investment in our sector.
Very quickly, do you want to touch upon the team at this point? I think we're probably skipping through to page 21, but it's always kind of good to understand who's involved and who does what.
Yeah, no problem. Page 21, you know, really what we put together here is a combination of the 3 companies. And if the board of directors, I won't spend a ton of time on, but it's a fantastic board with lots of experience in growing and creating companies. And with Ross being the chairman and the leader, he's the largest shareholder. He owns about 12, 13% of the company. And he has an active involvement in strategy and financing particularly. Now, we run the day-to-day, but when it comes to big decisions, we get our largest shareholder and our chairman involved. And he's created companies in the past that have been very successful. I think I heard him say the other day he's created 15 public companies that have been very successful. And this is going to be his last active one. And then the management team, we're all in sort of mid to late 40s, a couple in our sort of 50s, but we're kind of in that next generation, we think, where Ross has kind of, you know, had his successes towards the end of his career. We're kind of coming through a few recent successes. Myself, I've actually just come from True Gold, which was a turnaround story in West Africa, a gold mine there that was sort of on hold that needed to be constructed, and it ended up being sold within 14 months for about 6 times the price that when we went in, which was a very nice return for shareholders in that period into 2016. And then previous to that, we helped create Endeavour Mining, which went from 0 gold mines to 5 gold mines within 5 years. I did that from 2011 to 2015. I was a CFO there, based in Europe, but working in West Africa again. And prior to that, I was involved with New Gold, helping to create New Gold, which went again from a single company up to sort of multi-asset, multi-jurisdiction. So we really do have a track record and belief in creating these multi-asset, multi-jurisdiction companies.
Excellent.
And then the team around me as well. Jim Curry was the COO at New Gold. He had 4 operating mines and he was building a big $800 million project at the same time. Peter Hardy, the CFO, was ex-Nevsun and he was with me at True Gold. Scott Heffernan was at True Gold as well, who's an explorationist who spent a lot of time in Africa and in South and Central America as well as North America.
Tell me a bit more about Jim, obviously as the COO. Obviously he's quite integral to the operation. What have you tasked him with actually delivering for you?
Yeah, it's interesting. Jim took on the full-time role, say 2 months ago, I guess it is now. He was involved as a consultant helping us on the Aurizona project in Brazil, but he really comes from an operator's background. He's worked and operated in mines. He's helped build mines, integrate mines, buy mines, but he really is an operator's operator. He gets a lot of respect from the teams on site. He puts in place and empowers general managers who basically are the captain of their own ships. So we look at each mine as being its own ship, where they actually have to be responsible for everything they do down there. They're obviously accountable, but they're also responsible. And Jim has that sort of senior experience and leadership, particularly from New Gold, where I did work with him actually over a number of years, creating that company. But he's worked all over the Americas and Africa as well.
So he's going to kind of bring you into production, as it were.
Exactly. He's the guy there to make sure the operations are running well or getting up and running.
And he's hands-on, in-country, as and when, or is he working remotely? How does that work?
I mean, we do have our corporate office here in Vancouver. There's about 16, 17 of us right now. We will be based here, but we will go remotely to site when needed, basically. So for us, obviously, we've got 2 sites in California, very easy to get in and out of. So very accessible. And Brazil, he'll make a rotational tour in and out of there every month or 2 at the moment, because it's a very critical time. But he'll be hands-on on site as needed. But I think the key to it really is you've got to find leaders out that manage and run your assets as well, that have the ability, the seniority, and the leadership skills to run them with a lot of autonomy as well. Because a COO or a CEO can only be out there for so many days a month, per se. So
there's a team in place. They're managed quite closely by Jim and yourself, presumably.
Yes.
No new hirings required to kind of get things over the line.
Yeah, Jim will take the lead responsibility. Each of the individual mines or projects will report directly to him. So he is the #1 guy here in terms of responsibility, for sure.
Got it. And what's Greg's role and involvement?
Greg actually, interestingly, again on the merger we did previously, Greg came in. He was the CEO of one of the previous companies that helped form and create Equinox Gold. Greg's background is he was at Minefinders before. He was the CFO there. He was CEO of 2 companies post Minefinders, and really has the ability to help us sell the story, develop the story, the strategy, the investor relations side of things, as well as the corporate development. So he's also done a bunch of deals over the years and raised financing alongside those deals, and is really skilled in that area and has a good following in the market. So he's been a really nice complement to what I'm doing. It allows me to spend a bit more time in operations with Jim. And Greg has a bit more of the kind of investor relations, corporate development strategy approach to things.
So there's a little bit of investor relations and development, meaning potential acquisitions?
Correct. Acquisitions is a focus for us. We've obviously done a few over the last few years. Our goal here, as we said, over the period to about 2023, we'd love to be a 1 million ounce producer. Mm-hmm. With our current portfolio, we can be between probably 500, maybe 600,000 ounces. So we probably do need to buy at least 2 more properties or mines or companies along the way. So far, we've kind of done 1 per year. And Greg, really, that will be his key responsibility and role, is to actually find that next asset.
That's interesting. Okay. And so he's very comfortable with that institutional lead, as it were, in terms of talking to and updating institutional investors, but also, I presume, working with you in terms of any potential future raises. So you feel you've got the skills in-house to manage the process.
Yeah, and I think it goes to our philosophy and how we run this company corporately as well. Is I certainly have the philosophy that you got to have the best people possible around you. To be honest with you, I think you need to have people who are better than you in certain areas. And at times I feel like each one of them is better than me in each of the areas they're sort of focused on. But you know what? That makes a stronger team. We challenge each other. And guys like Greg, who have run companies before, he's been CEO of companies. But we work really nicely as a team. And I can't be everywhere all the time and talking to everyone all the time. Greg is able to do that. He can present the company at conferences. He can meet investors. He really has the ability to cover for me, in a sense.
That's great. It's just we quite often meet companies who have people who are very technically competent, or they're a promoter, or they're a finance guy, but to have all the skill sets in-house, it's rare. I guess you've got the luxury of being a little bit further developed and have a little bit more cash available to do that. So that's great news.
Yeah, I think that's true, but I also think we have the philosophy that when we all came in, we all came in with that sort of long-term vision and philosophy, and we knew we would need those skills along the way. So we put them in place early days. We put in place an incentive and compensation structure that sort of reflected a small company to start, but allowed us to grow. And all the team is focused on the same goal at the end of the day. And we all know that we need those skill sets early days. That's how you create a team in a company.
Okay, that's great. Okay, well, thanks for talking through the team. I'd like to say I think the board of directors speaks for itself. Some pretty big hitters in there. Let's get back to your 2018 report card and pick it up from there.
Yeah, so if we go back to slide number 3 here, the report card, very quickly to go through this, we did that merger to create Equinox Gold at the end of 17. So we ended up basically integrating them all at the early part of the year, but we were building the mine in Brazil called Aurizona. It's on track for commercial production around the end of Q1. It could be in April there. And we've also been exploring while we've been building that mine this past year. So we had launched into construction at the beginning of the year, and it's tracking very nicely into the first quarter of 2019. The second one there is Castle Mountain. That was the other asset that came in. It's in California. It's a past producing mine as well. We put out a pre-feasibility study in the summer this year in 2018, and it basically shows a 200,000 ounce producer for 16 years. It's a fantastic mine in California. It's right on the Nevada border. You do not find many of these scale and size and cost-based type assets, particularly in the Western US these days. And it's got lots of exploration potential as well. So both of those are past producing mines that are brownfield, reasonably easy to restart and put back into production. So once Aurizona is in production in Q1 this year, we plan to launch into construction at Castle Mountain probably Q2 or 3 this year. So you have a nice little runway of projects. One of our other objectives for the year was to acquire a producing gold mine. So we bought the Mesquite gold mine off New Gold in Q4 in October. It produces 140,000 ounces a year, so a nice producing base. So we have one producing mine already, Aurizona being the second one coming in soon. Then we've also increased our reserves and resources, and really valuation for a lot of these companies in our space is based on your reserve base. How long can you be producing this kind of gold? Well, we've increased our reserves to 5.7 million ounces, or 480% in the year, through both adding Mesquite and adding the reserve base of Castle Mountain. And then the other part of it, we also are quite disciplined in a sense. We had some smaller assets, and we said we want to monetize our portfolio, focus on the core larger gold assets. So we spun out our copper assets into a separate privately held company that we own 40% of and our current shareholders own 60% of. We plan to relist that on the stock exchange at some point in 2019. And it has 5 copper assets, mostly spread around South America, but also 2 of the discoveries coming from David Lowell, probably the greatest discoverer of copper porphyries of our time in the last century, basically. And he's still involved in the company. So a really exciting private company that will come back to the market soon, we hope. And then we sold our little small mill in Peru, which was for about $15-16 million. So that's really what we did this past year. And what are we planning to do in 2019? So we put out guidance. So it's the first time we put out guidance for the company. We'll be producing around 250,000 ounces at between $900 and $950 an ounce, all in sustaining costs for the year. That will really be made up of Aurizona ramping up into production around the end of Q1. We will be producing, 85 to 105,000 ounces there at about $850 all in sustaining cost. We would like to do some more exploration there for this year, and that will maybe come in the second half of the year when it's cash flowing. And then the second part of the actual guidance really comes from Mesquite in California. So it'll produce roughly 150,000 ounces at $950 to $1,000 an ounce, all in sustaining costs. So you have 2 producing assets producing that roughly 250,000 ounces of gold. So the last small parts of this plan for 2019, Castle Mountain, it'll go into construction in the second half of the year. We're just finishing off the engineering and permitting and financing for phase 1. It's a small build, $40 to $50 million. It'll produce about 50,000 ounces a year, but we plan to be in construction on that the second half of this year. All looking good. It's again, in California there near the Nevada border. And then separately on that, on the corporate side, we will continue to look for acquisitions. We're a little bit more go slow at the moment on that strategy because we're integrating the last one. But in the second half of this year, we certainly will be looking more actively at acquisitions. And the other interesting part is we would like to continue to refinance and improve our balance sheet. We've used some debt funding to buy Mesquite and also to build Aurizona, but they're separate debt structures, and one of them certainly is a little higher cost. So the goal is, with our core banking group of European and Canadian banks, we would like to see it rolled into one credit facility at a lower cost. And that's one of the advantages of being a mid-sized company. You have a better cost of capital. And then ultimately, we will be considering a US listing at some point along the way. We are also a very US-focused asset base at the moment. And one of our goals here is to keep our G&A at a very low level versus industry peers. And I think we've done a very good job at the moment. We're probably, give or take, $40 an ounce in terms of G&A costs. And I'll just flip on to page 5.
Yep, please carry on.
So on 5, I'll go through this really quickly, but it just gives you a nice pictorial of our growth profile. I've just described it in words, but this really gives you a picture of it. This past year in 18, we produced 26,000 ounces because we own Mesquite for 2 months. It will have 2 mines producing in 2019. That'll produce roughly 250,000 ounces. We'll have 3 mines producing in 2020, which could produce roughly 300,000 ounces. And when you get to the second phase of Castle Mountain in California and build that, it'll be producing 200,000 ounces, which will take us all the way up to close to 500,000 ounces a year. So we've got a nice portfolio and growth profile. We don't need to acquire anything. Obviously, we'd like to be slightly more diversified and larger than 500,000 ounces and 3 assets, but we don't need to do anything if the market doesn't support that. Turning on to slide 6, what is the valuation, play here? We've really come in the last year from a single asset development style company, which often they trade at discounts, as we all know. And, we use the main multiple of price to net asset value as our primary valuation metric. Of course, we look at all the others as well. Most of the developers tend to trade in that 0.4, 0.3 up to 0.5, 6, 7 sometimes, depending on whether they're permitted and financed. We've been trading, give or take, in the 0.4 to 0.5 range, as you can see on that graph. One thing that we do believe really strongly is you do see a re-rating as you get into production, become a junior producer, then you become an intermediate producer, which is probably 250,000 ounces of annual production. And then obviously one of the leading intermediate producers over longer term can be trading the multiple range of, 1 times, maybe a little higher than 1 times price to net asset value. So we think even with the gold price staying where it is today, and with the business plan and profile we have, there is a potential for a real re-rate over the next sort of 6, 12, 18 months here.
Okay. If I look at, let's take a look at last year. Obviously, the market had a big impact. And this year, I think people are hoping for the price will do something here. Last year you started at whatever, 135, 140 level, ended the year a little bit down, sort of, I think 105, something like that. The market was tough, but you guys were doing some great things in there. But I'd be interested to see what your view is, because we hear various excuses as to why shares haven't performed. What was your take on the market last year?
Yeah, there's probably 2 parts to that. I think the market is just generally tough again last year. Access to capital was extremely difficult. There's a lot of smaller, mid-sized companies that just weren't able to get financed. I think we had the luxury of having a Ross Beaty, Richard Wark behind us, and a few key core shareholders long-term. Lucas Lundine's even one of those shareholders. And it allowed us to have access to capital to continue to develop and build on the strategy. Yeah. The challenge we did have, I think, is the market was basically not interested in gold. Yeah. When you look at gold's performance and even our share performance, really when we closed the merger at the end of 2017, it was just below $1. I think our share price is just above $1 right now. So I'd call it a fairly static or flat year. And it's interesting. I looked at the GDXJ recently. I looked at gold and I looked at our peers, and I think gold was down 2% or something over the year. Our peers were down 35%. We were down about 8%. I think maybe it's 5%. Yeah. And then you look at the GDXJ, and I think it was down 15%. So overall, it was a really tough year in gold. And you had cannabis companies flying high. You had Bitcoin and cryptocurrencies flying high. The main markets were doing really well. But you've really seen in the last 3 to 6 months, I think, a rollover in some of those markets. A lot of speculative money that was jumping into those alternative type investments has sort of realized, oh, Bitcoin isn't $20,000 a Bitcoin now. It's 3,500 or 3,800. Cannabis, how much of that is really going to be exciting here when in Canada when it's been legalized. Really, it's still the same market. It just happens to be it's more formalized now. And I think a lot of those gains have already been taken out of the market on the speculative bubble, and they're coming off now.
Yeah.
And I think you're seeing the main markets. People are looking for safe havens, alternatives, other places to put their money, and slowly gold's getting a little bit more of a bottom and a bid. And I think our belief is over the next sort of few years here, gold will find a bid again. It seems to have been a bit stronger in the last 6 months of this past year. And we're building a strategy that will really take advantage of that. We don't need gold price to move, but if gold price moves, that's kind of the cherry on top of the strategy. We're going to build a great company no matter what the cycle does, but I really do think we're one of the beaten up sectors out there.
Yeah, that's for sure. You know, as you say, there's companies who've got way more than 30% down on the year, and it's and they have found it very difficult to raise capital. But just something you said there, obviously you're saying we don't need gold price to move, but obviously it's nice.
Yes.
Yeah, it was great, and you do have the luxury of having access, of having had access to capital, and potentially continuing to have access to capital because of the names associated. So you're looking at doing things like potential acquisitions. That's if and when something decent comes up, and building up that resource number. But what else do you think you could be doing this year to maybe get people interested in you? What if I look at last year, you've delivered some great things, great catalysts. The market was depressed. But people weren't interested. Do you think those things last year will start bearing fruit for you this year?
I really do think part of it is with building a company. It's a little bit of a show me story in a sense. A lot of investors don't want to jump into the risk when you're building a mine, when you're doing an acquisition and integrating it. What they want to do is start to see that actually is working. And I think, again, we've got 2 past producing mines. The one that's coming into production in Brazil, they want to see that it's actually ramped up and working well. That will be happening in the next sort of 3 months, a little bit longer to see the results coming through in the actual public markets. They'll want to see that. I think they want to see that Mesquite is actually continuing to deliver on what it has been doing over the last 10 years. Well, at least we put out our first set of guidance so they can kind of see what we think it will do. But I think it's also in this market, particularly in gold mining, there have been a lot of hiccups over the last 5 years. And I think a lot of single asset producers have really struggled. When you have one jurisdiction or one asset and something goes wrong, you don't have the ability to be diversified and weather those storms. And I think we've now got that portfolio that we can start to, number one, weather storms and prove things. When one thing's not working perfectly, you've got the other asset that's actually offsetting it. And we will have 2 of those now by the end of Q1, basically, and the third one coming in early 2020. So I think part of it's just delivering on the strategy that we're saying. I agree with you. We've achieved a lot last year, but people want to see you pouring gold, making cash flow, and actually putting it onto your bottom line.
I think that's right. So what's your time horizon in all of this? Because again, you made reference to the fact that if the price of gold doesn't move this year, it's not a problem for you. Are you looking a year out, 2 years out, 3 years out? You've kind of got the big company mentality. So what does that convert to?
I would say our time horizon really, and you'll see in here, we've sort of set by around the end of 2023, we'd like to be a 1 million ounce producer. So that's a few years out. We want to make longer term decisions and not just try and perform to the markets on a quarterly basis, because I think sometimes you can make poorer longer term capital decisions when you're just focused on a quarterly delivery schedule. And that's what the markets tend to be focused on. Having a cornerstone shareholder like Ross Beaty and Richard Wark, between them, they own about 20% of the company. They want to deliver on a sort of 5-year plan, not just on a quarterly or an annual plan here. And I think that will allow us to have the stability and the focus over that period of time. Obviously, we do need to deliver quarterly, but I think also we need to make sometimes the longer term decisions, which are a little more painful in the short term. Taking on a challenged asset like we did in Aurizona and actually rebuilding it takes time, takes capital, takes people. So I think the long-term strategy's got to win out over the short term.
And do you think that one of the advantages of your business is you have the luxury of access to capital? It allows you to be able to have a slightly longer term horizon than say some companies have.
It absolutely does. Because, you look at what Ross did when he built Pan American Silver. I think he said he did it over sort of 15, 20 years in a sense. And he still owns all the shares he owns. I think he owns more shares than when he started there. And he said his exit strategy at Pan Am is death. He's in his 60s, so he's hopefully got quite a few years left there. People have asked him, what's your strategy here on this one? He said, it's the same thing. I want to have a great gold company, a great silver company that basically he gives to his charities or leaves to his estate effectively. That gives management a real set of confidence and belief in the people behind this have the patience to deliver on a long-term strategy. Trust me, on a day-to-day basis, he's very impatient, and we focus on trying to get things done because you can't just focus on the future and hope it all happens in the short term. You got to keep focusing on getting things done on a monthly basis to deliver on that strategy, but you can't lose sight of that goal.
So that kind of begs the question, if that's Ross's attitude, I mean, and we've talked a little bit about the management, yourself and the management team, and how have you guys been incentivized? Have you got long-term incentives in this company? You know, again, some companies struggle because they have short-term holds, short-term incentivization, or it's just time-related rather than success-related. I mean, how have you guys set that up?
Yeah, I mean, it's probably two parts to that. And we've been really focused on it. And if you've been following our industry over the last few years, as the markets have been weak, there's certainly been a rebellion by some of the large institutional type shareholders. I know in particular one or two out of New York that have been pretty upset with executive compensation. So what we did when we first came in here, we said to the whole team, we said, we want to be shareholders and owners of the shares. So we bought shares on the day we entered this company. I've probably put in $1.6, $1.8 million myself. I know Greg has put in, not far off that number, and the rest of the senior management team put in a proportionately large amount of money. And none of them are seed shares or discounted shares. They are at the same price we've done financings at. So anyone else who's come into our stock has got them at shares at the same price. So we have probably close to $5 million invested in this. And for us being young guys who haven't had a huge win, it's big money for us. So we've got skin in the game. A lot of people talk about it, but they don't put their own money into it. So that's number one. Number two is we do have a long-term incentive plan, and it's a diversified plan. At each year end, we'll look at basically awarding, some options, but we focus on things like RSUs and performance share units, which, the performance share units in particular don't vest for 3 years. And they have very much are linked to shareholder returns, and total shareholder returns. So we have our own shares and we have a structure that links us to that. And our salaries are in the fourth quartile. It's all public information. You can go out there and look at it. We're in the bottom quartile, but we think over the long term, we're going to outperform and out-deliver, and we're willing to wait for that.
Okay, that's really comforting. Okay, thank you for that.
Yeah.
So just getting back into the detail of the presentation here. I think you're about to go into each of the 3 projects. Is that right?
Yeah, I'll walk you through starting from the producing mine on page 7, the Mesquite gold mine. There's a nice photo there of it's a pretty dry sort of desert-like area there in Southern California, right near the Mexican and Arizona border. Been producing for 10 years in the last go around, but Newmont was producing there, 30 years ago. So this has been going for a long period of time. It produces roughly 50,000 ounces of gold a year. You can see our guidance there of about 150 at just below $1,000 all in sustaining costs. And one of the key things we're doing, and if you look at the next slide on slide 8, is we're looking at what opportunities do we have here to, number one, extend mine life, but also to integrate it and fit it together with our mine up the road in California, being Castle Mountain. Now, part of the reason we wanted to buy Mesquite is it's a producing mine 200 miles down the road from Castle Mountain.
Got it. Okay, and just very quickly, you don't talk about grades here. So what can I take from that?
It's a low-grade run-of-mine heap leach operation, very typical of sort of the Nevada style, California style, Western U.S. Very amenable to heap leaching. So it ranges between 0.3 and 0.5 grams per ton. So that's pretty normal for that type of mine in that part of the world.
So obviously the AISC being around $900 at the moment, what are you going to look at the economics again, or revisit those economics and sort of see how you can shave that cost?
Yeah, I mean, it's run fairly well in terms of an operation. A few areas that we're certainly looking at are there some synergies with Castle Mountain? We believe we'll be able to do some joint purchasing. You're buying cyanide for 2 mines, you're going to get a better price. I've experienced that in the past. So things like that. You're going to have equipment sharing on occasion. You'll probably have some administrative costs and some people sharing between the sites. And also, we're looking at the overall leaching. Is there a slightly more efficient way to manage the solution or to optimize the leaching? There are also some very low-hanging fruit opportunities around the site that will potentially help lower costs. So back in the day when Newmont was mining here, they left behind, I'd call them waste dumps, but they're basically ore grade waste dumps.
Yeah.
These are dumps of material that effectively are at 0.3 grams per ton, which is our ore grade material. They were mining stuff at sort of a gram and above. So back in the day, the higher grades allowed them to leave behind this lower grade material, which is now great for us. So it's already sitting there. It's obviously amenable to leaching, and it's got shorter hauls. It's basically free dig, and you'll be able to pick it up, put it on leach pads, and leach it. So all those sorts of things are going to give us the ability to look at our cost base and maybe shave a bit off the costs.
Okay, understood. And you're surrounded, if I look at some of the other names around you, I mean, in terms of comps here, just to kind of back up that, as you say, it's pretty standard for that region. Who are some of the other players in the area?
Round Mountain's probably the best example that Kinross has there, and it's basically similar grades. You've also got SSR Mining, which has a mine in the region, which is, again, similar grades, similar type cost base. And, Mesquite was probably the best comparable to Castle Mountain. And now that we put the pre-feasibility study out on Castle Mountain, it shows that they're both very similar mines, kind of in that 0.3 to 0.6 gram per ton, very similar costs. Because what they are is a big dirt moving exercise. We are miners. You got a bunch of trucks, you got a small, reasonably simple plant. So if you can move your dirt efficiently and basically extract the gold efficiently, it's going to make you pretty good money at this point in time in that part of the world.
Yeah, it's interesting when you talk with retail, high net worth, family office type investors. Their understanding about gold is the higher the grade, the more money you make. But at the end of the day, the ASIC is the ASIC. It's the process you employ. So there are kind of almost two models, where it's small scale, high grade, or ultimately, I say, a earth moving exercise where you can process efficiently. And I guess you're not speaking.
Just looking at that question in particular, a very high grade underground deposit, I'm going to use a country example as Brazil, because there are a reasonable number of them. Narrow veins can be very tricky to mine. It may be a high grade, but if you miss that vein or you dilute, you can end up having a lot of problem making money from it. We have a nice big open pit. It's much more amenable to simple mining. You're not going to run into those problems in the same degree as you would underground necessarily.
It's just less technical, step and repeat versus having to, I say, intellectually chase something underground.
Absolutely.
Okay, understood. Okay, so that's Mesquite. And I'm looking at page 9 now, which is some of your optimization.
Yeah, so page 9 just gives you a layout, some of the past pits. We're still mining in the areas that are in color there: Brownie, Big Chief, Vista. You can see the leach pads. They're all very close together. We have some exploration opportunities basically to the right-hand side of this map. You can see the highway running through there, Highway 78. Yep. We have now got some exploration permits to the right-hand side of that highway, and at the edge of the Rainbow pit there to the right. We will be looking, in addition to these waste dumps that we hope to add to the reserve life, looking at some exploration as well. So we've got lots of potential at this site.
Okay, I think we're moving down to Aurizona.
Yeah, so a very different part of the world. Aurizona down in northern Brazil. It's right on the Atlantic Ocean. It's only a couple of kilometers away. You can sort of see in that photo on page 10, the light jungle area around it, sort of farmland and light jungle. It's not in the Amazon jungle like some of the mines. It's a reasonable distance from there. It's in Maranhão State. It produced for about 4 years between 2010 and 15. And it will produce roughly 95,000 ounces of gold in 2019. But on average after that, it should be producing about 135 to 40,000 ounces of gold per year for a full year. This mine was built in 2008-9, right during the financial crisis, if you remember. It was really tough to get access to capital. They built it on a shoestring. They built a plant. They started mining, but they didn't build the whole plant. So they never put in a crusher, and the type of equipment needed to handle hard rock and boulders. So they took the easy material, put it through the mill, made some money. The gold price started falling. They hadn't built the front end of the plant. The capital structure was challenged. So when they got to the point in 2014 there, they ended up shutting it down for basically lack of funds and making money. And they started accessing harder material, which they needed to build the front end of a plant and a crusher. So that's the key thing that we've done is we've taken all this infrastructure, a power line, back end of a plant, a camp, all the skilled labor force in the region, and we've said we can take that and we'll build the front end of the plant with a crusher so we can crush hard rock. Yep. And we'll get it up and running within about 12 to 15 months. And that's what we've been doing over the last year. And we'll do it for half the capital cost. And that's the really attractive part of this. If you were to build this greenfield, it probably cost you $275 million. We're building it for just over $150 million. So you're kind of getting it not quite half price, but similar.
But have you picked up any? I'm assuming this is both these projects are all fully licensed, permitted, nothing, no issues there. Is that right?
This is, yes.
Okay.
Yes.
And then the second point is, have you inherited any liabilities? Have you bought the company or the project?
I mean, you're in mining, so you're always managing your environmental and health and safety type of risks and community relationships.
Nothing on the balance sheet is what I'm asking. There's nothing.
Oh, in terms of, there's a small $15 million facility to Sandstorm, which provided some of the original financing back when this mine was built. So we do technically owe them $15 million. It can be repaid in debt or equity, or in cash or equity.
At some point in the distant future?
I think half of it comes due in mid-2019, half of it in mid-2020. So reasonably small amount of money.
But you got cash available for that, so it's not a concern.
Page 11, just a nice pictorial. I mean, this is the front end of the plant. This is where the capital really is going in this build. You can see a building on the left in the top left-hand corner of this picture. That is the old building. It did not have any of this mill structure on the right. So it's a huge amount of equipment that's gone in. That will allow us to process all that harder rock.
Phenomenal. Right. And what is this? I mean, how much does this kit cost, and what's it actually? It's
well, what you're actually looking at is probably going to cost you between $50–60 million for that, the mill structure. You got a SAG mill and a ball mill there. That's, you know, roughly a third of the capital that we're actually spending at this point in time.
Phenomenal. Okay. Great. And how many people do you employ on this side?
At the moment, we're probably at about 800 people. It was 1,000 or so at the peak during construction. We'll probably come below 800, maybe 700 or so. We're in full employment during the operations.
And then predominantly all local?
Basically, all are going to be Brazilian. There might be one or two expats in due course, but virtually 70–75% of them will be local as well. We really want to employ local communities and workforce. I mean, it's only to our benefit to be working with local stakeholders, providing income, employment. Also, local knowledge comes into the company. So if you go on to page 12, this is what really excites us about this property. I mean, rebuilding a plant and a mill and that, you know, that's not rocket science. It takes some money, capital, and time. But what's exciting is we see this as a district or a camp. We have 2,000 square kilometers of land in here. This is massive. Yeah. On page 12, you basically see a small proportion of that. This is basically our mining permit, where you can see the Piaba open pit in the middle, about 4 kilometers long. That's where we're mining the gold from. Atajuba on the left there, another 5-kilometer area, which is in that pink, which is basically golden soil anomalies. There's been a little bit of drilling in there. We think there's a nice structure that goes all the way along here for about 10 or 15 kilometers. We think you could end up doubling this mine life by drilling out Tatajuba. And Tatajuba, as you can see, a couple of drill holes there in the top left, just to put it in perspective. This is a 1.5 gram deposit in Piaba, where we're mining. But Tatajuba so far is showing us 13 grams over 35 meters, 2.7 grams over 56 meters, right near surface. So much better grades, a couple of kilometers away from our current plant and pit.
And how much data have you acquired along with this acquisition?
Yeah, it's actually an incredible amount. There's about 100,000 meters of drilling, and the core that's sitting in the core shed sitting right on site. So you've got all the historical drilling still there. So we're capitalizing on that, basically helping us understand our current deposit, but also helping us understand the other potential deposits in the area. So we've been out drilling Tatajuba. We've spent a few $1 million drilling it this past year. We've been drilling to the east. And once we're in production, we have a bit more cash flow, then we'll go back and actually drill off Tatajuba. And we've been acquiring the land as well, the surface rights to that one as well. So we really think the future of this Aurizona deposit is towards Tatajuba, as you can see on the map there.
And I guess in terms of drill rigs, etc., I mean, you running your own drill rigs or are you buying those in? I mean, how's that work?
No, we'll be contracting those in. We'll let the specialists and the experts do that. That's not really our game. We're miners.
Right. And this land, I mean, if we look at the topography here, it seems relatively flat, water free. There's any encumbrances technically for you?
It's relatively flat, high points, give or take 20, 30 meters, so very low. You can see the ocean on the right. There's some inlets coming in from the Atlantic Ocean, so those are sort of limitations to the eastern side. Yep. There is water. There's a rainy season. It's just sort of just coming to that now, but March, April are the key rainy months of the year. Yeah. You get up to 3 meters of rain there, so it's a lot of rain. Yeah. It's a lot like those tropical parts of the world where you get those sort of heavy concentrated rain months, and then you get 6 months of dry where you get virtually no rain.
Very short rainy season there. And I noticed the ASIC here is lower than the previous projects, so obviously it can't be that bad. And then you kind of got some lower grade activity off to the, well, I say lower grade, I'm looking at 84.3 in one particular.
Yeah. That hole actually, I think, was the 4th or 5th best hole in the world this year. So
right.
It's not a bad drill hole.
Yeah.
There's little pockets of gold, we think, to the east there. Obviously, it peters out as you hit the ocean there, but there's pockets of gold to the east. There is gold to the west in Tatajuba. Then you step out 10 or 15 kilometers, and there's probably another potential 2 or 3 deposits out there. So we see this as potentially a multi-decade mine that give or take 130 to 50,000 ounces. And if we find enough gold and extend the mine life long enough, or we go underground, which will be the next page, we will look at maybe, do you double the plant capacity here? Do you look at adding more power and actually doubling the plant capacity? And I know Ross would love to turn this into a 200 to 300,000 ounce producer rather than 150. Yeah. And if you go underground and you find these extensions along strike, there is a potential here that you have enough ore that you could increase the capacity.
That's interesting. I mean, and just touch upon the infrastructure. What do we like for roads, power, water? Yeah, the usual. How's that?
It is a remote site. It's a good 6-hour drive from Belém, which is sort of the capital of the north there, or San Luis. Yeah. The roads are good. They're paved. They're federal and state roads. Right. Power line goes right to site. It's hydroelectric power. It's other than Quebec and BC, I don't know where you get cheaper power. It's probably 7 to 9 cents a kilowatt hour, which is very cheap, and it's probably a few cents more expensive than in Canada here. But 1/3 of the cost of what I experienced in West Africa. So very, very good power, and it's very reliable. So far, I'd say it's been 99-point-something% reliable. So very, very good.
Okay. I know certain parts of Brazil have struggled with the reliability around hydro, yes. So that's good. That's good to hear. So, and if we kind of go to page 13, you start talking about the underground mine potential here. Yeah,
so this is obviously a long section, and it's basically the same Piaba open pit that you can see there in the gray. So that's where our reserve pit is. So that's the 1 million ounces of reserve. Yeah. But there's been some historical drilling down to about 600 meters of depth. That pit, the reserve pit, goes down to about 200 meters. About 200 holes have been drilled down below the pit level. I think all of them, except for a couple of holes, have hit mineralization. So longer term, we actually see the potential for an underground as well as an open pit here. So the geologists and the engineers have been taking the data that we have had to date. They've been working on a sort of scoping study and a PEA in the background. Yeah. And I think what you're going to see over the next year or so, we'll start to flesh out the story and the understanding of the underground potential a little more. But so far, what it looks like is, and again, we just highlight here, there's roughly 5 million tons here at almost 3 grams per ton underground. And that's about 500,000 ounces of gold. We think there's a lot more gold underground there. And considering our open pit is only 1 million ounces, you're already with almost very little drilling at half that amount. And we really think there's potential that you kind of double the mine life by just going underground here. Needs a bit more drilling and needs some more engineering work and study work, but we think the potential's there. And if you flip to the next page, this is getting a little bit more technical, but on 14, you can see the ore deposit there. These are cross sections that go across that long section I just showed you on the previous page, and look sort of down the ore body. And you can see sort of the yellowy beige color down the middle, or golden color down the middle. That is the ore deposit. It's nice, structured deposit, steeply dipping. You can see it go quite to depth there. And it's probably between 10 and 20, maybe up to 40 meters in width at times. These are not little narrow, high-grade underground veins that you have to follow that weave through the underground. These are consistent, long, wide underground potential ore bodies, and it makes for cheaper mining. It's competent rock. It gets quite hard as you go down deeper. Once you mine off that sort of softer surface material, you're into the competent material, and you have very cheap mining methodologies for underground mining there.
And the grades still remain very reasonable indeed. In fact, the odd large number in there, but they seem to be between 1% and 3% typically, with the odd anomaly of being at 9.97 there.
The big difference here is when you do see some of those really bonanza grade underground deposits, they're really narrow veins. We're talking like a meter in width, or give or take. At 10 grams, where what we're looking at is 20 to 40 meters in width, and it's sort of 3 grams, some of it's 4 and 5, but between 2 and 5 grams. And you can mine that efficiently when it's that wide.
Just before we kind of move on again into Castle Mountain, Brazil has had a mixed reputation for doing business. It's been quite peaky. It's been a brick country, and then it's all of a sudden it's doom and gloom, and we've got alternative politics coming through as well. So what's your impression of doing business in Brazil, and what's the future look like for mining in Brazil?
Yeah. Just stepping back even further, I think any jurisdiction has its own risks in a sense. Doing business in British Columbia, where I live, with the current government regime is just about as difficult, considering no one wants to mine anywhere near them or in this province, it seems these days, even though we're a natural resource province. Where I find Brazil is a mining country. It's a mining friendly jurisdiction. It's got a lot of big mining companies there. The challenges tend to be, there is bureaucracy.
Right.
There are sort of complicated tax regimes and structures, but really what you need to do is have the infrastructure and the overhead, in a sense, to manage through that. And what we've experienced so far is, you're right, it was a brick country, it's fallen off. So it's had an underinvestment for the last 4 or 5 years. It's had the Olympics, it had the FIFA World Cup, all that building and infrastructure is gone now. So there's been a lot of hungry contractors and construction workers for us to hire. A lot of the big mining companies in iron ore and some of the base metals have let a lot of people go over the last few years. We've been able to benefit that. We really believe that being counter-cyclical is the way to go. When others are downing tools, not deploying capital at down part of the cycle, we should be doing the opposite, because we don't want to be building mines at the top of the cycle. You want to be building at the bottom of the cycle. So,
well, it comes back to, I think, one of the key differentiators with you guys is the access to capital. It allows you to be counter-cyclical, where others can't raise money. Even if they see the same opportunity, they can't see their way to finding the cash to be able to take advantage of that situation. So I think that keeps coming back to that for me in terms of the story that's coming through here.
It absolutely comes back to that. We know of other companies that started out a year and a half ago at a similar point to us, sort of single asset in that. They're still in the same place.
Right.
We now have 3 assets. We have a good balance sheet, and we have access to more capital to grow the business. I absolutely agree. That's one of the key things in the down part of the cycle. And one of the faults of the cyclical industries like ours is, at the tops of cycles, you have a lot of people flooding in with capital, and it has to get deployed. So it gets put into marginal projects, marginal teams, and it doesn't get invested in the right places. Now is the time to invest in our cycle. And Ross Beaty is the master of investing against the cycle. Look what he did with copper in the early 2000s. He was buying copper for cents on the dollar, and then he sold them all as copper peaked around 2007. We're planning to do the same sort of thing in terms of investing in the sector while it's still weak. We don't necessarily have any plans to sell as it gets stronger, but we're building a business for the long term. We build it now.
So, question to that. So, if you're looking at retail investors, family offices, high net worths who are like coming into this, they can follow the names, the Ross Beatys of this world. They can buy into your argument with regards to counter-cyclical investment. But if they're coming in today, what's the upside for them? I mean, we've talked about valuations and moving from exploration into producer. You see some uptick there, but what do you say to those types of investors where the stock is maybe slightly tightly held by institutions who believe in the Ross Beaty story, or your story? How do we get the price moving?
Yeah, I mean, I think in a certain way, we've built a good business despite the markets. And I agree with you, the price necessarily hasn't reflected that at this point, because I said it's a show me story in 2019. And as an investor, and again, I put a lot of my own personal capital into this, you get a chance to buy the shares right now at the same price as Ross Beaty or myself. Ross has been buying shares as we've financed, and he's bought blocks of shares in the market at anywhere from sort of 95 cents up to $1, I can't remember if it's 15 or $1.30. So right in this range that we're at the moment. So there is an opportunity to buy the shares exact same price, but I think the business is actually better in advance since he's been buying the shares. So you're actually buying it at kind of a greater discount. So it's an opportunity right now. And again, with 2019 being the show me year in a sense, and all these plans that we have to kind of show the mines are operating well, I think now is the time to be looking at it, or certainly over the next 3 to 6 months.
Okay, well, let's see if that happens.
Okay, so looking at the last major asset here, if you go to slide 15, Castle Mountain, and in a way, this is a bit of the jewel in the crown at the moment, even though it's the third asset in our portfolio. The pre-feasibility study we put out in August shows you 3.6 million ounce reserve, 16-year mine life, 200,000 ounce a year at sub $800 all in sustaining cost. Yeah. This mine should be owned by a major gold mining company. It's in Western USA. Tax rates have been reduced. Trump, for all his tweets and problems, he's put in a lower tax regime. He's made permitting more efficient, at least. I'm not saying there's any guarantees you get your permits, but the regulators are actually been told to do their jobs and actually evaluate permits and either stamp them as being good, or if there's problems with them, they need to go back and go back to the mining companies. So we've been really encouraged.
Tell me about this. So why doesn't a major own it? How much did you pick it up for, and how much have you got to spend to get it going?
Yeah, so again, it's back to our philosophy. When we picked up the Brazilian assets, it had a bit of hair in Brazil and some challenges to restart the mine and raise some capital. This one is same sort of thing. Sometimes people look at California and say, oh, you can't mine in California. It's a very socialist type state. Guess what? I think it's one of the top 2 or 3 states in the US that has gold mines in it. Ross has operated 3 gold mines there before. I've operated 1 there before. So I think it's a bit of a misnomer. It's a past producing brownfield mine. And I think the 2 main question marks, I think, for the bigger investors when we did acquire this were permitting, which I think, we really don't think is going to be as big an issue as people thought. It takes time to permit in the US. You need to go through all your environmental studies and that, but this has got an environmental impact statement. And all we need to do for phase 1 is prove to the regulators that we're underneath the air emissions threshold. So we're in the process of doing that right now. We've submitted it already. We're not crushing material this time, and we're using more efficient, newer mining equipment. So we will definitely be under the old thresholds that were set back in the 1990s and 2000s. Right. So we should be able to prove that. And then you need to prove to them that you're not discharging water into the environment. This is a zero discharge project. So that's pretty straightforward to prove to them. So there's 2 minor permits to get that back in place for phase 1, which is the smaller mine. And we have all the water we need, which is the other maybe risk area that people see with a California or a desert-like mine, is water, access to water. Well, there's old water wells here, so we'll use those for phase 1. The water's there. What it does need for phase 2, which is the 200,000 ounce producer, which will cost us, give or take, $300 million to build over the next, probably 3 or 4 years, we'll build phase 2 to this. You do need to enlarge your footprint area of disturbance within your environmental impact statement area. So there's slightly more advanced permitting required there. We've started that already. And once you're back into production with phase 1 here, the smaller mine, to actually extend that and basically change the footprint is a lot easier, because you've shown you're a good corporate citizen. You've shown that you're staying within your environmental standards, your health and safety is good, your regulatory regime is being administered well. Yeah. And the second piece to that basically is access to a bit more water for phase 2. So we've identified water. We've got all the California water consultants out there, and we hope to be drilling that, give or take, mid-year this year, and showing that we know the water is there. We can actually see it. There's a huge aquifer that runs just south of the property. It's a matter of actually getting access to that land and getting the permits in place to go and drill it. So
it's interesting, actually. And without sounding like a broken record, again, your access to capital, I guess, put you firmly in front for acquiring this, in the sense that you look like a group who can get this into production, and not a group who are moving it along to a phase where you can offload it or exit, or the need to exit, because you'll never be able to raise, because $300 million is not something that's readily available to most.
Yep. No, absolutely. And I do think, some companies in our sector have been very defensive over the last 5 years, because investors have asked for that. The markets, in a way, have asked for that. And we've sort of taken that opposite approach, where we were able to take this asset with a little bit of risk attached to it, granted, but manageable risk. And I think once we de-risk it, then people will go, oh boy, maybe it wasn't as difficult as it could have been. And maybe we should have bought it when actually Equinox bought it.
But as a blended portfolio approach to this, I guess Castle Mountain fits in nicely to an overall story to deliver certainty and assurances to the investors, which is, I guess, a key part of your job. Okay, so let's get into it and tell us a bit about it.
So 16 is probably the only page I really want to talk around, and because it's quite simple. It's a past producing mine. Viceroy operated there for 10 years between 1990 and 2000 or so. They shut it down when the gold price hit 250 in the early 2000s. Operated it really well. We're a really good corporate citizen, so left us with a good legacy. On the right-hand side, you can see the diagram of the old pits. Well, we're going to go and mine again. Sounds very similar to Mesquite, some of the backfill material that basically is ore grade that was their waste. So we'll start with that. That'll be phase 1. Cost us $40 to $50 million. You put it into production, so you're producing gold in early 2020, and it'll produce about 50,000 ounces of gold per year in that first phase. Second phase, you do a little bit of that extra permitting, which I just described to you on the last slide. Give ourselves an extra couple of years to do that permitting. And then you go into phase 2 and spend an extra $250, $300 million of capital. But then you have a 200,000 ounce producer, give or take, in 2021, 2022. And that goes on for sort of 13 years at 200,000 ounces. And there's tons of exploration potential here. This is a large potential system and deposit. But with 16-year mine life, there's no need to look for any more today. Yeah. Certainly over the next number of years, we'll consider going back and drilling.
But this is another case of you guys using your skills in terms of heavy movement of earth, processing low-grade ore. Yeah.
Absolutely.
So same story, different location.
Same story as Mesquite. The one difference is in phase 2, we will build a small mill, which will take the high grade. So there will be a pocket basically of over 3 gram material, which we'll put through a mill. So it's too high grade to put on a heap leach, where you're only getting 75% recovery, and you're leaving 25% of the gold on the leach pad. If you get a mill, you'll get 90 to 95% recovery. So you're taking all that extra value and capturing it by putting it through the mill. So the high grade material we'll put through the mill.
So, and how much of that high grade material are you expecting? I mean, what data have you got?
It's about 2,400 tons per day. So it's, 5% of the actual tonnage of material, but it'll produce 30% of the gold. So that gives you a value play or arbitrage there. By putting it through a mill, you're putting 5% of the material through the mill, but you're capturing 30% of the gold. Nice. So that's Castle Mountain in a nutshell. And really, I have one more slide there on slide 17, just to bring it all back together. And what have we done and where are we heading? So very simply here, we've created an America's focused gold mining company with good sized assets that will take us into that mid-tier space this year. We have the ability within this portfolio probably to grow to 500,000 ounces of annual production over the next few years. but our ambitions are larger than that. And as you can see here, our growth strategy really is to aim for that 1 million ounce mark. We really think you can manage sort of 4 to 7 mines efficiently. The value creation cycle is through that phase of being a 1 or 2 asset producers through to 4 or 5 or 6. And you could create a balanced, diversified portfolio, ideally in the Americas, as you can see on this map. Yeah. But we are willing to look a little further afield. I mean, my team and myself had a lot of experience in West Africa. Doesn't mean we're going to go there, but certainly we'll look for gold and the great opportunities in unexplored areas and regions. But we'd love to stay close to home because it's always easier to manage a portfolio that's closer together.
Absolutely. Okay. So that kind of summarizes the projects and where you're at.
Basically, our structure at the moment is we have about 550 million shares outstanding. We trade on the TSX Venture Exchange at the moment. We'll certainly be looking to graduate. I think we're the second largest mining company on the TSX Venture Exchange. So we'll be looking to graduate in due course here to probably a US listing as well as a TSX listing, which gives probably more liquidity, more access to the shares for shareholders, also more visibility. And ultimately, we'd like to get into some of these ETFs and some of the more quantitative style funds as well. We're a little bit too small for that. You know, sub $500 million of market cap tends to keep you out of them. You don't have enough daily liquidity. But we've even seen already in 2019, you know, getting closer to 1 million shares a day in trading, or $1 million a day as well. That is kind of getting on that threshold. And once you get into these ETFs, obviously you have these program buying, you have more following, you have more liquidity, and that starts to attract the bigger funds, the more generalist funds. And that's got to be one of our goals here. So, you know, with that type of structure, we certainly hope over the next year as we get into production, you'll start seeing that liquidity breach that level that is attractive. And right now we're very underheld institutionally. We're covered well by banks. As you can see on slide 19, we have 8 analysts covering us. Even some of the larger Canadian banks are now covering us, so you can get access to pretty good research on the company. For a company our size, I think we outperform in that sense. And when you flip over to page 20, you can look at our shareholding base. The donut on the right there gives you a good picture. Ross has about 12%. In the high net worths, another 7% is probably Richard Wark. Another 2-ish%, maybe 3 is Lucas Lundin. So between the three of them, they're between 20 and 25%. Very sticky long-term shareholders.
Yeah, but so what's that doing? What's that doing for you? By the 41% float, I'm assuming that's a Canadian retail float, is it?
It's probably split between Canadian, US, and European retail. That's probably the 3 large proportions. We did have a lot of US retail support in the early days. Yeah. And we also have a pretty good European support as well, particularly in continental Europe.
Interesting. What, German, Swiss, that kind of thing?
Yeah, German, Swiss, French, I would say.
What are your plans going forward? Can you talk about, there's 23% institutional. Obviously that needs to change kind of going forward. You want some bigger blocks of investors coming through. You also need that liquidity, which potentially driven by, retail activity. I mean, how are you going to manage that?
Yeah, it's sort of one of the opportunities and maybe one of the weaknesses of how we created this company. We created it with a lot of entrepreneurs, wealthy individuals, long-term investors, and it was always a little bit small and under the radar of called the mainstream institution. And we were building at the down part of the cycle. So a lot of the main institutions have no capital. So they're not investing in new names, new stories, new stocks. So as you can see on the left-hand side here, we've listed a few of the institutions. So BlackRock has just come in our recent financing in October there to buy Mesquite. So they came from 0 up to 4.9%. So they're probably the main first key cornerstone institution in there. You've got Pacific Road and Sandstorm who were behind the Aurizona asset in the early days, so still have 4% or so each. And then you have a few more funds here on the left-hand side at 2 to, about 0.5% to 2% each. But it's still quite small and underrepresented from the traditional Toronto, London type or New York type investors in this space. So we're out marketing, telling a story. We certainly have found a lot more interest in the story as we've delivered on what we said we'd do last year, as we start to get over that $500 million market cap level, which we're at now. And I think what you'll start to see as we start to deliver on 2019 guidance, you'll see a few more funds start to pick away at the stock. As you get more liquidity, you can buy it in the market. If we have to finance in the future to build, say, the second phase of Castle, there's an opportunity, obviously, for someone to put some money in. So we'll just have to see what those those opportunities are for the institutions to keep coming in.
Right. Okay. And that would be well. You talked about taking out some of your or combining some of your debt products at the moment. So
yes,
I guess you're taking a look at equity and debt in the market, depending on which project you're financing and what stage you're financing that at.
yes.
But there's some pretty big numbers coming up.
Yeah. So at this stage, we've certainly in this part of the cycle, one of Ross's key philosophies was let's not dilute the equity holder too much. Him being the largest shareholder, he's got a really personal interest in that, which makes a ton of sense. So we used some debt to buy Mesquite and some equity, but we used as much debt as we could. And we've also used a bit of debt to build Aurizona. So as you consolidate those, we'll probably end up repaying some of them with cash flow, obviously. But if our share price were to run significantly, certainly we'd look to take out some of the debt at a higher equity price. We just think the equity price has been too low to dilute shareholders too much today. So we definitely wouldn't want to take out that debt until the share price is a bit higher for sure.
Right, and I guess as things move forward, as you say, the cost of financing gets cheaper, you'd hope.
Yes.
Get cheaper. Again,
absolutely.
Market conditions dependent. Okay, thanks for running through that. There are a few sort of supporting documents in the appendix, which I guess people can flick through. Thank you very much for your time today. That's been wonderful to hear, and it's something that we've been wanting to hear about for the past couple of months. It'd be great to kind of stay in touch every kind of quarter and sort of see where you've got to, and if you are continuing to deliver on everything you say you're going to deliver, and we look forward to sort of seeing the success of the company as it grows and goes forward.
Yeah, no problem, Matthew. Thanks for your time as well. It's always a good opportunity to meet some new people and to reach out to new investors as well.
Thank you very much for watching our video. We do aim to give you informed and intelligent information with which to make your investment decisions. So if you liked what you just saw, please give us a thumbs up. And if you want to see more insightful, in-depth, honest and unbiased interviews, then please click the subscribe button. So thanks again for watching, and we look forward to seeing you again soon.